Right, good morning, ladies and gentlemen, and welcome back to Boutiques on Wednesdays. Always great to have so many of you joining us this morning again. Great weather in Gauteng and good showers last night, or really nice rain, but very interesting on forecasting because if you look at AccuWeather, probably about a week ago, they said no rain, I think, until November. And here we had beautiful rain, so it tells you a lot more about forecasting and how that doesn't work now, does it? Today we will welcome Hollard Investment Managers as a newcomer to the BCI family. However, they might be new to us or to BCI, but they've got a phenomenal track record of 10 years plus. Their aim is to compound incremental outperformance over time at lower risk than the market. And if you look at some of their numbers, they're actually doing that or delivering on that promise. But not to steal their thunder, and here to introduce their business to us and their business model and more on just how they do it is Chief Investment Officer Ashvina Tilakdari Kushal. Good morning, Ashvina. So great for you to join us this morning. How are you doing?
Good morning, Eugene, and good morning, everyone. It's great to be here today with you all. Yeah, all good on my side, and appreciate the opportunity to present to you guys what Hollard Investments is all about.
Really looking forward to that, Ashvina. And like I told the audience, you've been in the game for a very, very long time. Definitely not new to the asset management world and how you construct portfolios. Really keen to understand your business a little bit better and dive into one or two of your funds to get a sense of what you're doing. If you're ready, you can start to share the presentation from your side. We can see if it comes through.
100%.
Yeah, I can see something coming through. That's the presentation. Yes.
I can't seem to move the slide though. Sorry. Can I
No,
try
that's
again?
fine. Yes, no problem. These things are never absolutely perfect.
Yes. Okay.
There we go. Yes, I
Can
can
you
see
guys
it.
see it
Full
now?
presentation mode. Your first slide.
100%.
Perfect. There we go. Thank you so much. The floor is yours,
Cool.
madam.
Thank you. Thank you, Eugene. And again, thank you everyone for your time this morning. My name is Ashvina Tilakdari Kushal, and I'm the CIO of Hollard Investments. Today in my presentation, I'll focus on the Hollard BCI Yield Plus Fund. It's a fund that resides in the ASISA short-term interest-bearing sector. And through this fund, I would try to highlight three key takeaways. One being that how the paradox of choice in fund selection can be solved. Second, why a multi-dimensional approach to portfolio construction is important. And third, why regular and rigorous qualitative assessment of managers is important. But before I do that and I jump into the presentation, I'd like to introduce Hollard Investments to you. Most of you would be familiar with the Hollard brand, particularly through its products in the short-term and life insurance space, but we do offer investments as well. Hollard Investments launched 8 CIS funds 10 years ago. But irrespective of the product line, we as Hollard, we live by our shared purpose, which is to enable more people to create and secure a better future. Just briefly on on what Hollard Investments does. Hollard Investment Managers offers a range of 9 CIS funds. We also offer bespoke solutions through our implemented portfolio solutions capability to the institutional market and the IFA market. We have a team that manages balance sheet assets, and we also have an investment platform where we offer discretionary and compulsory investment products, and we have about 17 billion rand of assets under administration. This is the management team, and the investment team consists of 9 individuals, ranging from senior portfolio managers to senior analysts and junior analysts. We are in the process of recruiting more resources, and one such resource is a data scientist. And the reason for that is to create more operational efficiencies within our business, particularly the investment process. Okay. This is an illustration of our investment philosophy. We believe that volatile return outcome imposes a volatility tax on investors. So what we've set out to do is to create return profile in a manner that's incremental and consistent. So what we want to do is we want to compound incremental outperformance consistently over time. And I'll explain how we do that, but that's what we've set out to do. And this philosophy basically is reflected in everything that we do. It's that golden thread that knits together our entire investment process, whether it's from a portfolio construction perspective, from a manager selection perspective. That objective is at the back of our mind when we create solutions for our clients. Okay. This is a snapshot of our range of offerings. So we have 3 income funds. The middle one on the left-hand side is the Yield Plus Fund, the one that we'll talk a little bit more about. Then we have 3 multi-asset funds. We have a property and an equity fund. And last year we launched the Hollard Focus Global Equity Fund. This is a UCITS fund domiciled in Ireland, and we are in the process of launching the feeder version of this fund. It's a great strategy, and hopefully I'll have the opportunity in the near future to talk to you about that fund a little bit more. Okay. This is a snapshot of our investment process. Investment processes are not very different, you know. It's pretty similar for everyone. But what I'd like to draw your attention to is the market analysis component. And that's what we believe is our differentiator. So across our range of funds, our benchmark is the median of the ASISA category in which that fund resides. Okay. And if you think about it, it's a very intangible benchmark. So how do we construct our portfolio to ensure that we outperform? And that market analysis is that secret sauce. And market analysis is really looking at the particular ASISA sector in which that fund resides and analyze that sector for its drivers of return. What's driving return in that sector? And we categorize it as risk premias, and in our portfolio construction, we try to capture those risk premias. Okay. This chart is showing the growth of CIS funds over time, and obviously this increase in number of funds offers more choice. More choice offers greater opportunities, but it also comes with greater complexity, and hence the paradox of choice. You know, which fund do you actually choose? This is a snapshot of funds in the ASISA short-term interest-bearing category. And if you think about this ASISA sector, it's quite restrictive in terms of its investment guideline, the universe of assets it can invest in. I think you can go up to a maximum of 2 years from a duration perspective. You can't invest in preference shares, you can't invest in property. So it's quite restrictive, but yet over the past 20 years, the number of funds on offer in the South African market has increased from 9 to 52. And that creates a complexity from a manager selection perspective, or it makes manager selection an important consideration. Okay. We believe that more choice is not equal to more quality. And the chart on the right-hand side aims to illustrate that. And this is in a very kind of, in a sector where the dispersion of return is still quite narrow relative to other asset classes or other sectors. So the chart on the right-hand side basically shows how much of return is your worst performing funds capturing of the best performing funds. So 5 years to the end of September 2009, the cohort of worst performing funds were capturing 92% of the returns of the best performing funds, which means that if you've chosen a manager that's the bottom of the pack, you're still okay because you're still capturing 92% of the return that the best performing managers are capturing. But over the past 5 years, that percentage has dropped to 77%. I mean, in other sectors, it's the picture is a bit more dire. So what does that mean? That means manager selection becomes very important. The chart on the right, on the left-hand side, shows the proportion of funds outperforming the market benchmark. In this sector, the ASISA interest-bearing short-term sector, most managers are using the STEFI composite. So I've used the STEFI composite here. And the purple line shows that most managers are very comfortably outperforming STEFI composite. But when you look at yourself relative to the peers, you can find that just about 50% of managers are outperforming a peer average. So outperforming the STEFI composite, is that good enough? Are you getting enough bang for your buck when it comes to the fund that you have chosen in this particular category for your investors? Is the question that we really asking. Okay. This is a snapshot of the performance profile of the Hollard BCI Yield Plus Fund. And two things I'd like to draw your attention to. One is that dotted line, which is the STEFI composite line. Okay, so this chart, just to talk a little bit about it, it's the cumulative peer relative performance. So if you take the performance of your fund, you minus that of the benchmark, and on a cumulative basis, you look at it, this is how the picture looks. So two things, look where the STEFI composite is. So is it good enough to outperform to generate a STEFI composite performance profile? Maybe not. And if you look at the area under the 0% line, it's much wider than the area above the 0% line. Okay, so our strategy aims to maintain that consistent outperformance profile, and risk is a very important consideration in that mix. What kind of risk are you taking to generate that performance outcome is important to us as well, given the kind of investors that invest in this sector. Okay, now the performance profile is important, but how that performance profile was generated, the quality of that return profile is something that we assess, and it's very important. There are various metrics that we use to assess that, two of which we are illustrating here. The batting average is a measure of consistency of that return outcome. and how consistently you've generated that return outcome. And for us, that's very important. It's a measure of whether we're living by the philosophy that we have chosen, right? So if we are in the purple or orange bars, then we are on the right track. Okay, so we are producing return outcome in a consistent manner. Information ratio shows the risk adjusted performance. So how much risk are you taking, and are you being compensated for that risk that you're taking? And you're not taking excessive amount of risk relative to peers, okay, in generating that return outcome. Okay, as multi-managers, when we construct portfolio, our aim is not just to blend managers. Okay, what we're trying to blend is risk premias, and that's where the market analysis component of our investment process basically comes live. So we analyze the sector and we look at the various drivers of returns, and we convert that into what we call risk premias. And in our portfolio construct, we want to capture those risk premias. So here is an illustration of the manager composition of the Yield Plus fund. So we have three managers: Granite, Prescient, and Matrix. And you can see that we have categorized them as core managers versus satellite managers. So Granite and Prescient are core managers because they use various drivers of return to create an outcome. But they are still different. Granite uses the credit lever a little bit more than Prescient does. Prescient uses more of their focus is more on creating real returns outcome, while Matrix is a manager that brings a different dynamics to the mix. They are a manager with a hedge fund background, and they bring in more kind of dynamic management, dynamic duration management to the portfolio mix, and hence why they are a satellite manager. So combining all these risk premias give us a portfolio outcome that we believe is consistent and generates the return in a consistent manner. But that's not all. So once we have identified those risk premias and we've put them together, the strategic weight is what we come out to position ourselves. But through the market cycle, we adjust those weights. We upweight, we downweight, depending on when we believe these managers have the best probability of outperforming. So for example, we have upweighted Matrix in a falling interest rate cycle because we believe this manager is very dynamic in positioning from a duration perspective, and they can benefit the portfolio in this type of market environment. Okay. Another aspect of our investment process, which is absolutely key, is how we look at manager selection. So there are two ways you can evaluate managers. One is qualitative and the other is quantitative. These are the lenses through which you evaluate managers. But we believe that qualitative assessment of managers is absolutely key. And the reason for that is that it provides you with a forward-looking view. When you look at quantitative measures or you do quantitative analysis, it's almost a rear view mirror view because you're using a data that, I mean, you've looked at what the manager has produced and you're trying to assess that. Whereas qualitative assessments gives you a forward-looking view. It averts you to the key risk in your portfolio construct that will manifest in the return going forward. And it also assesses the resilience of the manager composition. So qualitative assessment is very important, and it's a part of our process that we focus a lot of attention to. So this is a snapshot of what we do within that qualitative assessment of managers. So every 6 months, we do an on-site due diligence of all of our managers, and we rate them across these various pillars. This is a risk-based framework for assessing managers. So we look at business sustainability. Is there any risk from a business perspective that the manager is experiencing? You know, we look at their governance structure, their board of directors, their financials. So various aspects from a business sustainability perspective, we look at that. Key people, who are the key people, who are the decision makers, what is the depth and breadth of their investment team, is there any issues? So we test all of that. Their philosophy and process, are they doing what they say they would do? And also, is the investment process evolving and is it being enhanced over time? The performance profile and attributes, that's a bit of a backward-looking measure. We look at how the manager has done, what kind of risk they've taken to generate that profile. And portfolio construction and implementation, we look at what the portfolio looks like currently. We look at the holdings, and then we determine whether we believe this manager can deliver the return outcome that they say they want to deliver, given the construction of the portfolio currently. And recently, we've added an additional pillar, which is responsible investing. So what is the manager doing from a transformation perspective, from an ESG perspective? We look at that and we rate that. And we can tell lots of stories when it comes to these ratings. I mean, it looks like a nice, colorful chart, but a lot happens in that kind of a framework. Okay. Then this is my last slide. So multi-managers are often criticized for layering of fees. For us, that's a myth. And the reason being that just like we have a philosophy for how we want to generate return outcomes for our clients, we also have a fee philosophy. And that fee philosophy is we do not charge performance fees and we do not pay our underlying managers performance fees. Just like we want to generate a consistent second quartile return outcomes for investors, from a fee philosophy, from a fee perspective as well, we want to give our client a fair and competitive fee. So what we do is we take all the funds in the ASISA sector. For each sector that we have a fund in, we look at the range of TIC and we rank them per quartile. And our fee must be in the second quartile. Okay. And hence, as a multi-manager, we are comparing ourselves to single managers, multi-managers, the entire universe. Okay. And no matter how old we all get, we love free things. So if you are paying a fee that's competitive, irrespective of whether you compare yourself against a single manager or multi-manager, that extra layer of oversight or qualitative oversight of managers is coming for free. Okay. So in conclusion, the paradox of choice can be solved if you partner with the right manager. The quality of return profile is important. As much as the destination is important, the journey is as important. And that's really what this is saying. A multidimensional approach to portfolio construction is very important, aligning to the objective that you're trying to achieve. And it's not, if you look at the interest-bearing short-term sector, that dispersion of return is a function of how each manager wants to generate their return profile. There are managers that are extremely conservative. There are managers that are very racy. So a multidimensional approach that harnesses risk premia allows you to kind of pick and choose, but ultimately produce an outcome, a portfolio construct that's very robust. Dynamic portfolio construction can add value, especially at points of inflections in the market cycle. And qualitative scrutiny, which is almost a rigorous, regular qualitative scrutiny of managers does provide better forward-looking insights, and fees do matter. And we believe we aim to provide transparent, competitive, and a fair fee structure. On that note, thank you very much.
Rina, thank you so much. Really insightful indeed. Short time to pack in such a big array of solutions, and we only focused on one of your mandates. To our audience out there, you know how it works. All our managers have an open door policy, and we can definitely get you in touch with the Hollard team if you want more information. But before we go away, I've got a couple of questions for you, Asrina. I'm watching the Q&A box as well from the audience. If you want to post any questions, you're more than welcome. I just want to talk a little bit more about your portfolio construct methodology, and let's stick with the fund, or start with the fund that you presented on now, the High Yield Plus Fund. We saw the three managers there, Prescient, Granite, and Matrix. I mean, we're all familiar with Granite. They've been on our sessions and roadshows numerous times, Bronwyn Blood, so we know all very familiar with their mandates. But let's talk about something like concentration risk. Yes, the Granite Fund, or the mandate, is, you know, they use multifacets to generate income. You mentioned credit as one of them as well. But let's talk about something like concentration risk. I mean, you've got 45% exposure to a single manager. Are you not worried about, you know, the tail starting to wag the dog?
That's a great question. Thank you very much, Eugene. So as a multi-manager, you would expect us to have a portfolio with multiple manager, and we are diversifying. We believe when we create a zoo of managers within our portfolio construct, it's not diversification, it's diversification. And for us, we have a high conviction manager selection approach. We believe as multi-managers, we are skilled at choosing the right manager. And at times, we can even hold 100% exposure to that manager. If you look at our property fund, we have one manager, which is Sispikile. And the reason for that is when we look at that sector, there isn't that variety of risk premia that we can capture. And in that instance, there is no need to diversify further. We can stick with one manager. But it's when that qualitative scrutiny becomes important. So like you said, if it's concentration to one manager, how are we managing that concentration risk? And that's through that rigorous scrutiny of the manager. We look at the manager not only in terms of the product that we are buying from them or strategy we're buying from them, we look at them through, like, you know, what is their business doing? What are the key people doing? What is their process across the board? And that helps us mitigate that concentration risk. But a 45% allocation to a manager shows our conviction to the manager. And we believe that a smaller universe of manager or composition of manager allows us the opportunity to better assess the manager and see what they're bringing to the pot. When they're not bringing what we expect them to bring into the pot, that's when we make a decision as to whether we exit the manager and bring in another strategy, or we reconstruct the mandate. Maybe one thing I need to mention, Eugene, we don't go and just pick a strategy that the manager has off the shelf. What we do is we co-create with the manager. So in the Yield Plus space, if you look at Granite, Granite doesn't have a product on offer space. It is a mandate that we have co-created with the manager. Similarly, the Prescient has a fund in the Yield Plus space, which is the Prescient Yield One Plus. But this is not the strategy that you see in our fund. We have co-created a different strategy with Prescient that we have on offer in our fund. So we do a lot of that. It's not your typical multi-manage fund where you put together a whole bunch of managers and here you are. Yeah. Thank you.
I mean, that leads me into my next question with regards to fees. I mean, Specifically on the Yield Plus Fund, attractive fee, all in 58 basis points. That includes VAT as well. So that partly explains why you managed to keep the fees down, because you run segregated mandates in the income domain. You also have a dynamic income fund, which is in the multi-asset income space. And let's maybe move on to that fund, because in a current environment, in a rate cutting environment, we're seeing a lot of people shifting into multi-asset income funds where you pick up a little bit more duration. Your approach when blending portfolios or constructing a portfolio, is it a similar approach in the dynamic income as the Yield Plus? So high conviction, high concentration?
Yes, 100%. It's the same approach. So the dynamic income fund has two managers, Prescient and Granite, and both of them are co-managers. And in this falling interest rate cycle, we have seen the managers both increasing the duration of the portfolios, almost to close to the max allowable limit. But there is research ongoing to enhance the construct of the dynamic income fund. We believe in the current environment that we are in, having a satellite manager that can play duration more actively is going to benefit the portfolio. So we are in the process of doing that. Yeah. But the current construct
And
of the portfolio, we believe, is robust.
in the current environment in the market cycle, I mean, what would your advice be to investors? I know, it's a bit of a tough question because it all depends on what the goals are of the investor. But in general, would you advise clients to move more into dynamic income where you get a bit of a yield pickup and a bit more duration? And what is your duration in that fund?
Thank you, Eugene. Another great question. Um, I can't really give advice, but I can talk to the characteristics of the
Putting you in the
fund.
corner here.
Yes. So the duration of the dynamic income fund is close to 2 years. That fund cannot take as much duration risk. Within our multi-asset portfolios, the fixed income building block, there we have increased duration. So previously, we were using the dynamic income as a building block predominantly, but over the course of the past 18 to 24 months, maybe 18 months more specifically, we have introduced higher duration funds. So we've included an allocation to Satrix Active Bond Fund, Saffron Active Bond Fund,
Saffron,
Satric Bond,
yes.
just to increase the duration. I don't know, you can see where our thinking is going from a duration perspective. The market cycle that we are in, a falling market cycle, duration does just pay off, but one has to be also very careful around just blindly taking on duration risk, because it does result in higher volatility in your portfolio. So you have to look at everything holistically. Where you are increasing risk, you need to assess whether that downside is fairly compensated. So it's really a balance of what you're trying to achieve.
Let's continue the conversation on asset allocation, and let's maybe we started moving into your multi-asset mandates. The balance mandate's always very popular with a lot of clients, especially with intermediaries looking for a solution, an all-round solution for a client. And I mean, that's exactly what you do with your funds. It's an all-round solution for various risk profiles and different CSR categories. As a multi-asset high equity fund, specifically on your equity exposure, and let's talk about SA equity. Do you look at things like style blending as well, where you blend different investment styles, i.e., quality, momentum, value? And how do you blend those investment styles? Is it a neutral position, or do you have specific tilts in different cycles? And what is that focus at the moment? What style do you prefer?
Okay. Thank you,
A
Eugene.
loaded question.
Another great question, though. Um, So when it comes to investment style, let's talk about SA equity. We believe that the market is too concentrated for us to kind of blend style. So we are style agnostic. What we want to create is all-weather portfolios. So if I think about our equity fund construct, it has a core, which is a passive core, and we've supplemented it with a manager that can produce incremental return outcome. It's a multi-style portfolio construct that generates an all-weather return outcome. But
Gotcha.
there would be times when we could add a satellite manager that can bring a different dynamic to the portfolio construct. And that's something that we are exploring. But we don't blend style. We try to invest with managers that produces all-weather outcomes.
Maybe to lift the skirt a little bit more, what equity managers or SA equity managers do you use at the moment?
So currently we use Vunani. So with Vunani, we have a strategy that is a peer tracker strategy, but recently ASISA has splitted the category, the SA
Correct.
equity category into the cohort that invest offshore and the cohort that is only SA only. So that has undermined that strategy for us. So we've unwinded that. And currently we are invested with, or we're investing with Stanlib in the Stanlib multi-style, enhanced multi-style strategy. And we are on the lookout for another manager to complement the mix. Yeah.
Very interesting indeed. With your global equity exposure, I can see that you do make use of iShares as well. So more index tracker based funds. What's your current views on global? I mean, again, this is maybe a bit of a loaded question. Developed markets, especially US markets, appear to be very frothy. Some say, but that's where you find the top quality companies. You don't have to buy top tier of Magnificent Seven. You can still pick up some decent quality companies in that space. Other global managers will say, but you need to, start fishing in other ponds, whether it be developed markets, emerging markets. What's your views on global equity at the moment? Are you just neutral? Are you just buying trackers, or are you specifically looking at specific regions to get away from the frothy stuff?
Thank you, Eugene. So global, since inception of our funds, we have passively invested in global equity. But currently, the risk in global equity and investing via an index has significantly increased because you have a very high concentration to the US market and a very high concentration to tech stocks, okay, or tech sector. So to
Yeah.
mitigate those two concentration risk, we've included an allocation to a manager called Seidel. So Seidel is the manager that we use in the Hollard Focus Global Equity Fund. And the way that manager manages money, they look through the cycle and construct a portfolio that will deliver consistent return outcome. And if you look under the bonnet, you will find that they have currently an underweight to the US and underweight to tech. And we believe that manager complements a passive offering very well to produce almost a robust global equity return outcome. So that's what we've done in our global equity construct. But currently, from a developed market equity perspective, we are positioned neutral in a neutral fashion. Whereas SA equity is where we have upweighted, or we are overweight SA equity, we are overweight SA property, and global assets we've slightly underweighted within our multi-asset solutions.
This wouldn't be an investment discussion if we don't talk about things like currencies, especially in multi-managed portfolios. Something our clients always ask us. We've seen the rand gain momentum over the past couple of months, positive outcomes on our elections, rate cuts in the US. How do you manage currencies in something like a balanced fund, your multi-asset high equity mandate, or the Hollard BCI managed growth fund of funds, how sensitive are you to things like currencies? And where do you view the rand at the moment? Are we in for a bit more strength in the currency? And how does that impact your global asset allocation?
Thank you, Eugene. Another great question. So from a
All the
currency
tough ones today.
No, it's a great question. So from a currency perspective, we don't forecast currency. We don't forecast the rand. We believe it's a fool's game to forecast where the rand is going to end. But what we do is we have a model called the purchasing parity model, so the PPP model, and we look at where the rand is on relative to the PPP. And the level of expensiveness and cheapness kind of directs us into how we need to be positioned when it comes to the rand. So of late, over the past 12 months, or even prior to May 2024, the rand went into a very, very cheap territory, okay,
Yeah.
for a good 12 to 18 months. At that point, what we did in our multi-asset portfolios, we introduced currency hedges, okay, as a way of mitigating against the risk of the rand strengthening and the portfolio experiencing a downside as a result of that. So we brought in currency hedges. Of late, we've unwinded all the currency hedges, especially after that stable and business-friendly election outcome. We've seen the rand appreciating aggressively, so we took the opportunity at that point to unwind the hedges. So from a total offshore asset perspective, we are currently underweight the dollar. So yeah, so we don't specifically call the rand where it would be, but we believe now that gap between the PPP and where the rand is has shrank, and we comfortable to be positioned the way we are.
And I mean, that partly comes back to risk management as well. And to
100%.
where we started with this whole presentation, is trying to minimize the volatility in the mandates, be it your fixed income mandates or your multi-asset mandates. I mean, that clearly pulls right through all the mandates that you manage. Ashrina, unfortunately, it's all the time we have this morning. There is so much more we can discuss. You've got a wide range of solutions for clients. We only picked on some or very little of actually what you do. I see there is a question from Lance as well with regards to the performances of the fund. We have tried to get that through to you, Lance, and we'll share that with the audience as well. And like I said earlier on, you know how it works. If you need more information on the Hollard funds, how they approach portfolio construction in multi-managed solutions, and how you can get access to these mandates, more than happy to put you in touch with Ashrina and her team. Ashrina, from our side, thank you so much for joining us this morning. It's been very, very insightful as a newcomer to the BCI family, but like I said, definitely not new to the investment world. It's been great to have you with us. Thank you so much.
Thank you so much, Eugene, and thank you to everyone on the line today. Really appreciate your time. Thank you.
Fantastic. To our audience out there, quick reminder, next week, Wednesday, again, 23rd of October, we've got Cartesian looking at money market. But why money market at this point of time? Well, we have to wait and see. See you all next week, Wednesday. Again, thank you so much for joining us this morning, and thank you for your continued support. Always great. Thank you so much.